The US stock market remains close to their record highs even after the declines we've been seeing as of lately. It's been more of a calm type of market, more in the red territory, but that strength reflects optimism about growth and Fed rate cuts as far as still being near record highs. And Bob Elliott over there at Unlimited Funds says that there's this risk of disappointment rising, and he put it pretty bluntly. Conditions are lining up to disappoint. And why this is the case is because Elliott believes that markets are too optimistic about where we could go regarding the Fed and their cutting of rates and tariffs, which could create unpredictable inflation in the longer term. And markets have really been moving on what the Fed's been doing. And today we got the Fed's July minutes, which highlight this same uncertainty regarding tariffs, which are already raising goods prices even as services inflation begins to cool, which, remember, services makes up a large part of GDP here in the United States. And what this does is it complicates the inflation picture overall because growth signals are also mixed. We got consumption slowing, residential investment declining, and while policy is modestly restrictive, officials feel positioned to react to this tariff bump that we've gotten in the inflation data. And that backdrop explains why futures still price nearly an 81% chance of a September cut and 2 to 3 cuts by the year end. Who knows what will fall on that scale, but it's unusual to see stocks still near record highs while multiple cuts are still on the table. Usually those two don't necessarily coexist unless growth is weakening. And when you think about it, why would the Fed cut rates? Not because the economy is just doing phenomenally well. I'll leave you there. Now, on bonds, Elliott argues they look more attractive than stocks right now, and the reasoning is behind an immigration and tariff policies which will drag on growth from his point of view, offsetting the recent fiscal boosts we've gotten from things like the tax and spending bill, for example. And the bond market is signaling this already. So what we see is the 2-year treasury yield has dropped from 4.4% to now about 3.8%, which this fall has been on the fall since December, reflecting rate cut expectations. Yet the 10-year treasury yield is stuck around this 4.3% range, which it's been in for quite a while, and it's higher than that of a year ago. The curve has steepened and short end pricing is dovish, but long end yields are resisting. So in part due to deficits, tariffs, and concerns about inflation expectations. So what this is telling us that easing may not be costless, if you want to put it that way. The economy itself is also slowing. PIMCO's Tiffany Wilding points to weaker real consumer spend in the first half of 2025 and slower growth. Elliott also adds that the labor supply and demand are both softer, leaving unemployment at this 4.2%, which we've been here for quite a while, so it's not like this is just skyrocketing. We've been in this 4% to 4.2% range for quite a while. So with immigration curtailed, labor supply is constrained, so slower hiring and weaker consumption eventually will bleed into revenue growth, margins, and especially as these tariffs raise costs that can't be necessarily passed through to consumers. Meanwhile, tech stocks are wobbling. The NASDAQ fell more than 2% across just the last 2 days, with names like Palantir down double digits for the week, Micron off 4%, Apple losing 2% mainly because they're losing this AI race. I just seen this article talking about how the Google Pixel phone is really killing it AI-wise and how the iPhone's AI just completely sucks, and I agree. So some of this is sparked by Sam Altman hinting at bubble-like dynamics in AI, calling it a bubble. Still, 7 of the 11 S&P sectors rose on the day, suggesting rotation rather than panic. The Dow barely moved all week, and that is seen as its calmest stretch since that of 1994. But it's not all bad news, so strategists are divided here. And strategist Tom Lee sees 2025 in 3 phases. So tariff fears early in the year, which the early part's gone, a hated V-shaped rally since spring, and a potential dovish Fed plus ISM recovery phase next. His year-end target for the S&P 500 is around 6,600, contingent on rate cuts and manufacturing surveys recovering overall. But others like Mark Newton expect a more opposite thing to occur, like a fall for correction first. Bank of America sees mega caps lagging if the cycle is shifting towards recovery, with valuation stretched at the top. Nvidia trades at over 34 times forward earnings, Palantir at more than 150, and that leaves them vulnerable to rotation even if the long-term AI story is still intact, just because they're so bought up. Dan Ives over there at Wedbush remains firmly bullish, calling pullbacks viable and suggesting Palantir could become a $1 trillion company in the near-term future. But valuation is key. That's the key theme. The S&P 500 trades at 3.2 times sales, which is far above its longer run average of 1.9. Tech and communication services are especially extended, while concentration risk is high. So we got names like Apple, Microsoft, and Nvidia alone make up over a fifth of the index. Still, the NASDAQ screen shows dozens of companies growing sales rapidly while trading below their historical price to sales averages. Now, what that offers are some relative opportunities in growth, at least stretch valuations. So let's talk about the Fed politics, which also entered the spotlight. So President Trump called on Governor Lisa Cook to resign over mortgage fraud allegations. Cook denies any wrongdoings and says she'll cooperate and intends to remain. By law, a Fed governor can only be removed for cause, a high standard. Markets are watching mainly for whether this episode undermines Fed credibility. The mortgage fraud risk issue matters because risk management is a key player here. Misrepresenting a property as primary residence gets borrowers better rates and lower down payments. And historically, what we've seen is up to 7% of loans showed such misrepresentation before the 2008 crisis, but recent estimates are below that of 1%. But still, fraud loans carry higher default rates, raising systemic risk if they resurface in larger numbers, is what we begin to see overall. But looking ahead, what we got is Jerome Powell's speech at Jackson Hole Symposium. That's the key event with the key player. Markets want to know if he prioritizes tariff-driven inflation or softening labor. Does he defend cutting rates? Does he defend against cutting rates? So right now, September odds for a cut remain around this 80% figure. Nvidia earnings are coming up, so this will also be a test for the AI growth story. Where do we go here? Are they beating? Are they still beating to what the market is entertained by, I guess? And bond yields around this 4.3% on the 10-year treasury yield still remain the ceiling that could cap equity multiples, even if the Fed trims the front end of the yield curve. So the bottom line here is that markets are priced for strong growth and multiple cuts, which are a narrow landing strip that are vulnerable to tariff, inflation, or labor market weakness. As valuations are stretched, bonds are sending a warning, and politics are just adding to the noise. So the next few weeks, we got Jackson Hole, we got the September Fed meeting, we got Nvidia's results, and that and a lot of all of the other economic data, news lines, press releases that we get will tell us if the market can extend higher or if expectations will finally reset. Either way, y'all, I'll see you there.